Welcome back to Market Shares. I'm your host, Tony Blodgett, and today I have with me Mike Hicks, who is the West Coast Regional Manager of Reverse Mortgage at New American Funding. And I've been looking forward to this conversation because, I don't know a lot about reverse mortgages, but what I do know is there's probably a lot more individuals and families out there that could really benefit from exploring a reverse mortgage. And it's just kind of my general consensus that a lot of people have kind of a bad stigma. There's kind of a bad stigma around reverse mortgages for whatever reason. And I'm hoping in this conversation with Mike here today, we can kind of talk through what it really is, who it's best for, and maybe remove some of the stigma around this product, because I do know that we have a lot of aging members of our society, a lot of seniors in our society who have a ton of equity tied up in their homes and could maybe be leveraging some of that equity while staying in their home to help fund, their lifestyle and get through their retirement years. So, Mike, welcome to the Market Shares podcast. I'm excited to have you here.
Yeah, thanks for having me. I appreciate it.
Yeah. So maybe just quick introduction. We know who you are and where you work, but maybe, a little background, how long you've been in the mortgage business, how long have you been focused on doing reverse mortgages, and just anything else about your kind of background that you want to share with the audience here.
You got it. So I actually accidentally jumped into the mortgage business probably at the wrong time. I got in the business in 2000, about 2007, 2008, doing traditional mortgages. And as we know, during 2008, that was when the market crashed, and it was pretty tough to be a mortgage originator. But decided to stay in it for a little bit longer, and didn't think it was going to pan out. And wildly enough, had a reverse mortgage jump on my desk around 2009, and I haven't done anything since. So reverse mortgages are kind of part of my blood in the last 15 years. But essentially, what took place in that particular transaction is I had a lady come to me and say, I'm looking at a reverse mortgage. My husband had passed away, and I'm 3 months behind on my mortgage payment. And I just thought to myself, holy moly, what are we going to do in this situation? Fortunately enough, we were able to help her out. We were able to pay off her existing mortgage and give her just that comfort of knowing that she'd be able to live in that property the rest of her life without the burden of a payment. And it changed her life. And of course, things have completely evolved. I mean, we have folks that use the reverse mortgage for line of credits, for supplemental monthly income, which I'm sure we'll talk a little bit further about here. But I've been doing reverse for the last 15 years.
Yeah, I only originated one reverse mortgage in my whole career, and it was one of my past clients who came to me who wanted a reverse mortgage and had already started talking to, I believe it was Wells Fargo at the time. And he's like, "Do you do reverse mortgages?" I'm like, "Well, our company does, but I don't." And he's like, "Well, you're the only person I trust, and would you do this loan for me?" And so I pulled in the help and support of our reverse mortgage specialist at my previous company, and we helped put that deal together. And he was very happy with the way it all turned out. But what I remember from that was, a lot more upfront work than I kind of remembered, a lot more than what you would see in a typical mortgage. There was, quite the thorough application process. But in addition to that, there's counseling required, and there's other things that were necessary in order to be able to originate that loan. So I'm sure we'll talk about more of that as we go. But before we do, if we could just set the stage, there may be people watching this episode who don't even know what a reverse mortgage is. So in a kind of a brief overview, can you just give kind of the elevator speech on what is a reverse mortgage?
Yeah, absolutely. So I'll put it somewhat in layman's terms. A reverse mortgage is a mortgage. Okay. The only difference with the reverse mortgage is that this is a federally insured, backed by the FHA, the Federal Housing Administration product for folks that are over the age of 62 that have the ability to either access or utilize a portion of their equity to maybe do some things that they want in retirement, whether that, pay off a mortgage, to remodel their house, to pay off debt, maybe even just have a standby line of credit that they can access in the future if they need to. Now, the difference between a reverse mortgage and a traditional, let's call it a home equity cash out refinance, which we see a lot of folks utilize, is that on a reverse mortgage, you actually get to defer your payment. So in the event that you don't want to make monthly obligated payments, you still have to keep up with your taxes, still have to keep up with your insurance, home maintenance, things of that nature, but you have the ability to extract a portion of that equity and actually pay it back either when you vacate that property permanently or you sell the home in the future.
Okay, yeah. So I've heard people lately referring to reverse mortgages under different names than reverse mortgage. And I think it's because of that stigma. But one of the names I've heard is like, payment optional loan,
Right. Yeah.
something like that. Would that be a misleading way of stating it? Or is that in fact the case with all reverse mortgages where you don't have to make a monthly payment on them?
Yeah, I mean, the entirety of the program is bound to come up with flexibility. I mean, that's the whole idea and premise of the reverse mortgage, right? So the actual standard name of it is home equity conversion mortgage. Many years ago, they decided reverse mortgage was going to be kind of we'll call it the nickname of it. But in theory, if you look back at what the reverse mortgage entitles, is it allows you to make a payment if you choose to at any time, but you can also defer that payment in the event that you don't want to make a payment or something comes up where it just makes more sense to live in retirement without that payment.
Right. So what would be the benefits of someone making a payment, or is there a scenario where it might make sense for someone to make payments for a while, knowing that they may have to draw on it more in later years, or maybe they still have an income? Are those the right line of thought there?
Yeah, absolutely. I mean, some folks want to continue to make a payment like they would if it were to be a traditional mortgage, let's say. Well, they put this in place sometimes to refinance into a reverse mortgage to allow them in the event that life altering events happen in the future, right? If they decide to finally retire, unfortunately lose a spouse, life happens in retirement, but it gives them the ability to stop those payments in the event that they need it to. But some want to keep the principal balance down, right? If they're worried about what they're leaving behind to their estate, their heirs, they do have the ability to pay down on that to leave a little bit more equity behind if need be.
Okay, so they can treat it like a regular mortgage, but with an insurance policy kind of built into it
There you go.
in case something comes up. Okay, I like that. So what are you mentioned the person, that kind of got you started doing reverse mortgages was someone who was behind on their payments. What is the current status of someone's situation that we might not consider them to be able to be qualified for a standard mortgage, but they might still be able to qualify for a reverse mortgage if it's someone who has a lot of equity in their home, they meet the age eligibility requirements? I mean, do they have to have good credit? Do they have to have income initially to qualify? Maybe talk through some of those differences between what we would think with a traditional mortgage.
Yeah, so it's a little bit different in the fact that we do still take a look at credit, we still look at income. It is still a mortgage loan. We've got to make sure that as we press forward, that folks are able to keep up with their obligation of their loan. Now, again, it's a little bit unusual because there is no required principal and interest payment on a reverse mortgage monthly. Still have to keep up with your taxes, your insurance, HOA. But when we look at credit, we actually don't even look at the credit score. We look at credit trends, right? Have you been making payments on your installment loans, your revolving loans, your taxes and insurance through the years? If you've kept up with those, you would qualify on the credit aspect of it. And as far as the income goes, we're just looking at strictly from income to debt ratio, right? It's not an actual, what most would know on the traditional side is debt to income percentage, but we need to make sure that they have the means and ability to pay those taxes and insurance after all of their other monthly obligations are taken care of.
Okay, so you're not looking at what the total payment would be to keep up on the mortgage, but more just the taxes and insurance. Now, would you consider at all the amount of money coming potentially from the equity of the home to help with those payments? Is that considered in that equation, or do they have to be able to make those payments on their own with other more traditional types of income, like maybe Social Security or other things?
Well, since it's an optional payment altogether, they can make any nominal payment that they want, whether it be $1, $10,000, They can make any nominal payment each month as they choose to. That's where the flexibility lies, right? On a principal and interest payment, we are bound to whether it's a 15-year or 30-year mortgage, we've got to pay that fixed payment each month. Whereas on a reverse mortgage, you don't. You have complete control over that.
So I guess my question is we know that they have to keep up on their taxes and their insurance. Would you consider the money that they could draw from the reverse mortgage as qualifying income to help them make those payments?
We don't. So we actually get to utilize a portion of what is available to them in order to qualify on the income side. So for example, if they don't have enough income via, Social Security or pension, we do get to offset that with what we call residual income as part of their overall retirement portfolio. So that does help in that situation. Correct.
Okay, perfect. So what are some, and this is kind of a general question, but what are some myths that you think? I mean, it sounds like you've done a lot of reverse mortgages, counseled people through this process. What are some myths that you're aware of that people think happens with a reverse mortgage, but in fact is not the case? Or maybe it's something that's changed over the years and is no longer the case.
I think the number one that comes to us is that the bank's going to take our home. Okay. And that's one of the biggest myths out there. Matter of fact, this is just like any other mortgage out there, where the lender, the servicer, is going to lend you a portion of your equity. And ultimately, when it's all said and done, we need to make sure that we don't over exceed our equity allowance to the borrower. But essentially, one thing I've always told everybody is mortgage lenders and servicers aren't in the business to capture properties. They're not in it for the real estate. They simply are lending, making the interest on the loan. And then when the time comes, when the loan's due, either they can sell the home and walk away with the remaining equity, and or their estate would inherit the property and be able to retain that equity at that time. So that's number one. I think the second one is we hear a lot is the fees are expensive. Well, just like with any other mortgage loan, there's going to be your ancillary third-party fees, right? You've got title, appraisal, other fees of that nature that are third-party. But with a reverse mortgage, there is a mortgage insurance premium that is required by the FHA. It's 2% of the appraised value. Well, when you hear that on the onset, you've got a $500,000 property. That's a $10,000 closing cost up front, which does, in theory, make this a little bit more expensive than most loans out there. But what it does is it protects the homeowner and the estate in the event that they access more equity and interest that piles up through the years. If they were to ever get upside down, this makes this a non-recourse loan, which means that they can never owe and or their estate owe more than what the home is worth. They could simply walk away.
Yeah, so I think that's a really good thing to point out is, we've seen a lot of appreciation. We've talked about it on this podcast all the time, the massive amount of home appreciation we've seen. But look, I was in the mortgage business back in 2007, 8, 9, 10, where we saw home values drop by, in many cases, 50% or more. I don't think that's going to happen anytime in the near future, but anything can happen, right? Sure. And so with a reverse mortgage, I think not only are you not going to lose your home, or is the bank going to take it back, there could be a situation where you could end up borrowing a lot more against a home than what it's actually worth at a future date, right? Because if the value did drop for some reason and you already set up what your structure might be and the maximum amount that you can borrow against that loan, there is a circumstance, and there has been circumstances where you end up owing more, if you will, on the home than what it's worth. And that debt is non-recourse, like you mentioned, right? That does not follow through. Your heirs don't owe that difference or whatnot. So having that mortgage insurance premium in that case would truly be like acting as an insurance policy against that negative, right?
That's exactly right. Yeah, it's that comfort level of knowing, right? I'm utilizing my equity to help better fund and give me a more comfortable retirement. But I also know that my estate or whomever I leave my property to, no matter what takes place, I know that they don't have an obligation to themselves. There's either going to be equity left that they can walk away with, or, when they sell the property, or if it's upside down, they can simply walk away.
Well, and I've actually heard of circumstances, and correct me if I'm wrong, that I have this right, but if the home were underwater, the family has the ability to purchase the home at a certain percentage of the appraised value. Is that accurate? And can you explain that?
That is correct. So if the family decided that they want to keep the property, and I'll just use an example, let's say it's a $1 million property and they owe $1.1 million when that time comes. The family can actually come in and purchase the property if they want to keep it in the family for sentimental reasons or whatever the case may be, for 95% of the current appraised value. So any of the other difference that was owed is going to be taken care of by that mortgage insurance premium, but the family now can purchase that property at 95% at that point.
Yeah, I mean, I wasn't aware of that until recently, and I thought I understood that right. That's pretty amazing. And if you think about scenarios where and again, I don't see this happening in the near future, but look, there's been times in history where values have dropped, and if the timing of that were such that the house was, pretty far underwater, perhaps, you're purchasing it based on the appraised value, not on what they owed at the end of that deal. Very interesting. So let's identify, if we can, is there a perfect candidate for this? I mean, should anyone that is over 62 years old that has a lot of equity in their home be considering this as an option, just almost like having, like a life insurance policy in place? Or is this something that there's a specific kind of target that you think would be someone who definitely should consider this, but maybe it's not for everybody?
Well, I think it can go a couple different ways, right? And I've always used the analogy, it's like sitting on a stool. If you're about to sit down on a stool, would you rather have one leg under you, three legs, five, whatever it may be? But we look at it and we always say, as we head into retirement or soon to be retirement, you've got your current employment income that's coming through, and at some point you may retire and that will go away. You've got your Social Security, you've got your pension, you might have checking and savings, you might even have a nest egg in your retirement portfolio. But as we all know, folks are aging longer, right? And coming up with the differences to make sure that you feel adequate and comfortable enough to make it through retirement. Once those legs start to fall out from under you, you start to get a little wobbly. You start to realize, does it make sense for me to have accumulated all this equity, all this hard-earned, money that I put into this property that I could potentially use to supplement my income and give me a little bit more of a comfort buffer? So, for those that are, especially in retirement, that have no plans of ever leaving their property. I mean, we have folks come to us all the time and say, we're in our mid 70s and, the good Lord's going to have to take us out from under here. We're not leaving, but they still have a monthly mortgage payment. Why not allocate that money that you're paying out on your fixed income and help supplement yourself? Go use that money to travel. Use that money to help the grandkids, things of that nature. So, I wouldn't say there's a perfect candidate, but I will say that, having that equity trapped in the property that you can't do a whole lot with does provide some additional liquidity and opportunities to help fund a better retirement.
Yeah, no, I agree. Well, I could even imagine that there are people who have done a pretty good job of setting themselves up for retirement, but maybe a lot of their assets are in the stock market or things like that, which fluctuate. They go up and down. And I don't know about you, but the worst time to be pulling funds out of a brokerage account is when stock values are down. So, having this in place seems like it could be a good strategy to hedge against the volatility of your other retirement funds, because if the stock market just drops by 20, 30, 40% because we had a crazy year, we all know that it's probably going to come back, but probably not the right time to pull money out for living expenses. You could use your reverse mortgage, let your, other investments recover and use that as a hedge against, those changes in your other kind of the other legs of your stool, if you will, that might have more volatility built into the type of structure that might be.
Absolutely. Well, one of the unknown things about the reverse mortgages, obviously we talked about those that want to maybe potentially pay off their mortgage, right? If they've got a $1,200 note and they want to just exhaust that and not have to pay that out over the next 10, 15, 20 years, whatever their term is, that's one part of it. The other part of, and what we see more of, is the reverse mortgage line of credit. And the line of credit actually has a growth rate factor to it. So based on the current index, it will actually be guaranteed to grow, which in today's market's growing at about 7.5% guaranteed. So for those that have retirement portfolios where they're having to pull out, let's call it, I think the national average is around 4% to live on comfortably and hopefully not outlive their retirement. In these down markets, instead of pulling out so much money out of those retirement accounts, you could leverage some of the equity and allow those portfolios to stay whole and do what they need to do, once they recover. And that's a great time to help, bolster that is if needed.
So let me make sure I understand this right. So the line of credit, let's say you put in place, a $500,000 line of credit or whatever, let's say $500,000. So are you saying that if you don't use it, what's available is growing? Am I understanding that right?
That is correct. It's a compound growth. So for folks that may not need the excess money or equity in their property this time, they could actually start up the line of credit early on in their retirement days and let that sit there and grow, compounding. And right now, again, it's about a 7.5% growth. That $500,000 in 15 years could be in excess of million and a quarter. Well, all of a sudden now they, need help with in-home health care or other avenues or just extra income. Now it's available to them. And so that's the beauty of the line of credit.
Are you paying interest on that though at the same time?
So they are not paying, you're only being charged interest if you access the funds. So only the portion of funds that is borrowed over time is actually accruing interest. So I always like to tell everyone the money that's growing isn't considered interest that you're gaining. It's allowing you to access more equity in the future if you need to.
Wow. Okay. I don't think I really understood that myself. I mean, that seems like basically you're doing a reverse mortgage. You're not drawing out the money. So you're paying closing costs to get it all in place, but you're not paying interest on drawing anything out. And matter of fact, you've created an asset that's basically going to appreciate over time until such time that you need it.
That's correct. So we see that quite a bit. Financial advisors love this in the fact that they know that they can put this extra bucket aside into their performance on how they're going to take care of their liquidity and assets in the future. By having this extra bucket with that growth, it just gives them that much more cash to be able to access in the future. So it's a really great financial tool.
Wow. I didn't even really understand that. Okay. So we mentioned the line of credit. You mentioned, maybe just briefly describe the different types of reverse mortgages out there. And then I also want to touch on, isn't there a product that's available for people that are under 62 years old? Like, isn't there, I've heard of something like maybe it's available at 55 years old. Is that something different? Or maybe touch on that if you could.
Yeah, so there's different variations of the we call it the HECM product, the home equity conversion or the reverse mortgage. So the number one, and that's probably about 80% utilized, is the standard FHA insured product. And with the FHA insured product, we can do lump sum payments, which may be to pay off debt, mortgages, things of that nature. We've got the line of credit option, which we just talked about. And then we have the monthly payment option, which they would receive a payment for the rest of their lives based on the formula. So it's all based on age, home value, interest rates, and that will decipher what we can pay out for the rest of their days. Now, through the last few years, we've had some additional proprietary products hit the market, which has certainly opened the doors for other clients to look at it on the reverse mortgage side, predominantly on the jumbo reverse mortgage side. We're seeing that home values, especially on the West Coast, maybe some other parts of the country, that they're looking to access or allocate more equity out of their property. The jumbo product, $1 million plus, is usually where we're seeing those home values, that these products are coming into the fold. But it does give them a little bit more ability to access that equity if need be. So that's important. Now, there's other products that have come on the market recently that do allow for 55 and plus borrowers instead of 62 plus. And those products, again, they vary by state. They are not, it's state specific at this point, but we do have the ability to access if we need to in those
Okay.
specific states. Yep.
Okay. So just to clarify, so a reverse mortgage could be used where I have a mortgage on my house. I have some equity, but I have a mortgage. I can't really afford the monthly payment. So I want to pay off that mortgage and maybe do some improvements, maybe get some debt paid off, and then basically just not have a monthly payment moving forward. I'm just paying my taxes and insurance as if I own my home free and clear, essentially. So that's kind of the one scenario, if I have that right. And the other main scenario is where someone is taking a more of a line of credit idea, right? So I'm going to put this in place. I'm going to do the line of credit. I might fund some of it up front because I need some money right away, but I'm going to put, maybe I own my home free and clear in that case, and I'm going to just have this line of credit available, maybe pay off a small mortgage, consolidate some other things, have the rest of it available for future use. If I don't use it, sounds like it's growing, which is pretty amazing. And then the last scenario could be, I have a lot of equity in my home. I'm going to pay off my mortgage. And in addition to that, I'm going to have the mortgage make me a monthly payment every month, right?
That is correct. That is correct.
Okay, so
and that's the wonderful thing about I talked about flexibility earlier. We can tailor this to anyone's specific needs. This isn't a one size fits all, right? Some folks have a small mortgage, some want a line of credit and monthly payments. We can literally put this in just one ball and tailor it to their specific needs as they move forward in retirement. So it's a pretty neat product.
So how long has this HECM mortgage product been available in its current state?
So there's been some reiterations of this product through the years. The first reverse mortgage, I think, in the country, I believe, and I'll have to fact check this, I think it was in 1969. So this isn't some newcomer, product that's come through. And then, of course, about 20 years later, I think that's really when the reverse mortgage product in itself started to kind of get some legs and take off. But really, the bones of our new product and where this reverse mortgage product has landed in today's market. Back in 2015, I believe it was, we had what was called a financial assessment come into the fold. Prior to financial assessment, there was no income and or credit qualifications whatsoever on the product. Well, we started to realize that folks had to have the means and ability to pay those taxes and insurance. And that's why we do the financial assessment, to make sure that they're able to keep up with their end of the obligation. And then that's an important component. So again, it's still, this isn't just for everybody. We've got to make sure that folks, just because they have the equity, are still going to have the financial wherewithal to be able to take care of the necessities needed.
Okay. And then I also know that more recently because what a lot of people would do that wanted a reverse mortgage is they would buy a home cash, and then they would turn around and have to do a reverse mortgage. But then I don't know what year it was, but the reverse purchase transaction became available. Do you remember what year that happened? And can you talk a little bit about the reverse purchase mortgage?
Yeah. So the reverse purchase actually came much later. And again, I don't have a specific date, so I don't want to just keep throwing numbers out here without them. But
sure.
The reverse for purchase, I think, is going to be one that we're going to see a lot of push for, and really for a couple of different reasons. We look at equity that's grown so much over time, and folks are getting to that position where maybe they want to right size. They want to downsize into a property that fits their needs, and they're able to take that current property that they live in and go and right size down. And let's call it a $500,000 property. They can now go buy a home that's $300,000, put $150,000 down, and keep the rest of the cash that they sold their existing home for. So they get into this new property, no mortgage, no payment, but also put a lot of cash in their hands as well, which is what we want in retirement, right? I always say cash is king in retirement. Twofold. You see a lot of retirees or soon to be retirees that are looking for their dream home. They're looking for that home that they've been looking for all these years. And let's say that you have that $500,000 home, but you want to go buy that $750,000 dream retirement home. You can actually take the equity from your existing home, put it down on your new purchase, still get in there without a monthly mortgage payment, or coming up with traditional mortgage financing or liquidating money out of your retirement portfolio to bridge the fund of that difference in the gap. So it's a very unique product, and I think we're going to see a lot of it. We got a lot of folks moving closer to families, closer to medical facilities throughout the country. It's just a great way to kind of get into a position where whether you're right sizing or trying to find that dream retirement home, you kind of have that bridge with this product because you can allocate that equity towards it.
Yeah. Well, I think that, unfortunately for a lot of the baby boomers, right, which is what we see as our kind of retirement, generation right now. For so many people in that generation, and I don't have stats, so this is just kind of my opinion, but the most amount of wealth that they've accumulated is through home ownership. And most of that equity is tied up in the homes that they own. And, you mentioned pensions earlier. I mean, not a lot of jobs have pensions anymore. It's not normal to have a pension. At most employers don't offer them. You might have a 401k. Not everyone is super diligent about putting that money away. So pensions, except for like maybe government jobs and a few other unique situations, was something that I think in previous generations they relied on, and now it's essentially not a thing, for most families. But if you purchased a home, I mean, I showed some math just on I think last week's podcast or the week after. I mean, just since, in the last, since 2019, home values have gone up 30%, and they went up, massive amounts since 2008, obviously, where things dropped down and then they've come up. But if you go back over the last 30 years, home values are up significantly. So this is where I feel like a lot of Americans have an aging, that aging demographic. A lot of their money is tied up in their equity, and they're trying to figure out, what do I do here in retirement? Not even realizing that there's this tool that may be, for many of them, a really great situation. And it might be the right time to get it in place while you're still kind of at the tail end of your working career. You're not fully retired yet, so that you can, more easily meet some of the other requirements, get yourself kind of set up and ready to make that move into retirement. I think there's a lot of people who right now are a couple of years from retirement, have no idea how they're going to do it, sitting on a ton of equity in their home, not realizing that these options are out there.
Yeah, I mean, we're talking about historical highs, as far as home appreciation values. There was an article that recently came out that said there's $12.9 trillion, and that's with a T, of folks that are 62 and older's equity that's tied up. And I sit here and I look back through all these years of helping folks with this product, and I start to realize that you put all the hard-earned equity into that property. If you need to extract it to give yourself a more comfortable retirement, especially with the cost of living, I mean, we're seeing it day in and day out. Everything's getting more expensive, and as you alluded to, if you don't have a pension, Social Security is only going up a couple percent each year. It's not keeping up with the cost of inflation. So, to have all that equity trapped in these properties, that they can not just sit back and think to myself, well, I finally got it paid off. I don't want to take out another mortgage. The beauty of this is you can defer that payment. You can still use that just as if it was cash in your own hand. And then you can defer that and have it paid back later on in life. So certainly want to give folks the best ability to have that comfortable retirement, because ultimately the last thing you want to do is, once you give up your working days, is to have a lot of stress about the financials. If you can have another leg on that stool, it's a great opportunity to utilize it.
Yeah. So it seems to me it's pretty obvious that a lot of people could benefit from this product, especially the largest demographic of humans we ever saw, which was the baby boom generation. Most of them are ideal candidates, or could be ideal candidates. Why do you think there's not as many people taking advantage of this? Is it really the stigma? Like, they learn about it and they go, God, I wouldn't want to do that. Or do you think it's more of just, they don't know about it? They don't know that it exists. And there's been enough negative stigma where people are just like, oh, you wouldn't want to do that. Why don't even look into that like that. I mean, what do you think is the main reason?
I would say you're pretty spot on. Stigma is a big piece of this, right? There's still a lot of those misconceptions that, it's a lack of public awareness, I think, of the product. It may be a lack of enough public education and getting out there and really telling folks, what the reverse mortgage is, overcoming those objections or concerns. But I've always sat back and looked at this product and always told myself, this is one of the most underutilized products. And now we're getting to that point where folks are saying this product almost sounds too good to be true, as opposed to 15 years ago, it was there's no way, no how. Now it sounds too good to be true. So now we're overcoming that objection, which is that this is no different than the first mortgage, second, third mortgage you took out. The only difference is you're just not making a payment, and you're going to use that equity as cash to live on for retirement. So I think that's really kind of the bones of the push of it. But as I mentioned earlier, the cost of living has gone up substantially. And, there becomes a point where once you start to exhaust your retirement portfolio, you start to exhaust extra streams of income, you've got to replace it somewhere, somehow. And if not, you're going to end up selling your house, walking away with the equity, and probably going to rent somewhere. Well, it's kind of a double-edged sword, because if you go rent in this environment, it's also a very high rent market, probably the most historical highs ever. So, if you'd prefer to stay in your property and kind of bridge that gap that you're missing, whether it's in your retirement portfolio or wherever it is, that's just a great opportunity to do that. So the too good to be true isn't that you still pay interest on a mortgage just like any other traditional mortgage. It's just deferred down the road.
Yeah. Well, I look at it. I mean, that line of credit thing is an amazing product too. It sounds like, I always tell people that having equity in your home is like the worst savings account in the world. And the reason for that is because there is zero rate of return on equity that's just sitting there. With that line of credit, like you mentioned, that equity turns into an investment, you know. And one of the biggest reasons why people pay off their mortgage is because they feel like they don't want to have that monthly payment. Well, with this option, you don't have to have that monthly payment, and you may be able to use it for other things that you may need in your retirement years. You get the best of both worlds, as far as I can tell. Now, I could see where your heirs might not love it. Like they were hoping that, when you're gone, they would inherit that home, or, they would inherit that equity. And yeah, I guess that's something to consider. But I'm going to err on the side of, when I pass from earth, I hope that I'm going to swallow my last nickel, as my dad used to say, right? Kind of jokingly, but it's like, hey, I'm going to make sure that I'm comfortable, and it's becoming more and more difficult to do, to your point, with the cost of things and what we've seen there. So interesting. But yeah, equity's sitting idle in your home. Look, reverse mortgage or not, you guys, just let me talk about this on this podcast. Just having a bunch of equity in your home, not only is there's no rate of return, it's not liquid. Contrary to popular belief, when you need that equity most, you can't get it. And it sounds like the same thing here with the reverse mortgage. I mean, if you got to a point where you needed that equity, it's possible you might not even qualify for the reverse mortgage at that time. And your only choice may be to sell that home in order to free up that equity. So don't be fooled thinking that, oh, I'm saving it for a rainy day. Using your home as a savings account is usually not the best idea. It does not grow. There is no rate of return, and it's not liquid like you think that it might be, without having, in many times, to sell that property. All right. As we kind of wrap up here, Mike, I want a couple other things I want to touch on. Let's just say that I did a reverse mortgage, and for whatever reason, I decided this wasn't for me, and I want to refinance out of it, or I'm going to change my mind. I mean, can you get out of a reverse mortgage at some point in the future if you wanted to? Could you refinance it back to a traditional type mortgage if for some reason, like maybe you joined, maybe your family moved in with you and they were going to take over the home long term, so you wanted to get that back into a fixed rate mortgage because interest rates were better, something like that. I mean, is there scenarios where you can do that?
Yeah, absolutely. I mean, it's just an FHA insured loan, right? And
Okay.
just like most FHA loans, there's no prepayment penalty. So at any point that they want to pay off that loan, they're more than welcome to do so.
Well, that's most of my questions, Mike. I think that I want to keep this to a reasonable amount of time because I want people to watch this. I mean, this is such an important topic, and you guys, this is not the first episode I'm going to do on reverse mortgages, because I think that there is a lot of families out there struggling right now that have a ton of equity, are not sure how they're going to deal with the rising prices of everything out there, and they're sitting on equity with this idea that for whatever reason it was instilled in us, maybe from our grandparents to our parents, to this generation, just like, pay off your home, owe nothing, and that's the best strategy moving forward. And I think that because of that, people are suffering unnecessarily. They don't want to sell their home. They don't want to move out of their home, but they also don't know how they're going to retire. So if you know somebody who could benefit from just some of the details that we outlined here on this episode, please share this episode with them and then reach out to me. I don't do reverse mortgages. I don't originate reverse mortgages. Our company does. Mike works over in that division. We'll certainly get you connected with someone who can give you some more information. But this isn't even about, the fact that we both work at New American Funding. Look, get your mortgage, get this information from somewhere. We happen to be one of the options out there. But there's lots of people out there in your area, in your market, that do reverse mortgages. I don't do this podcast necessarily to, bring in mortgage transactions. I just happen to know Mike and know that he's got a lot of knowledge, and I'll bring on some people from other companies or other backgrounds, maybe even a financial advisor that really understands how to work the reverse mortgage with your financial planner. That is something that is, and I don't know, Mike, do you ever talk to financial planners as part of the process and have some people that are really understand how those two things can work in concert with one another?
Yeah, I think that's what we're seeing more of, actually. I mean, 10, 15 years ago, financial advisor would shut the door on us pretty quickly. But now that they're starting to realize that this is another liquidity bucket that can be accessed and can be a retirement tool, they certainly look at this and say, you know what, we could put this in concert with some of these other financial vehicles. This is a great opportunity to get that extra leg on that stool. If it's never used, it's never used. It doesn't cost you anything. Even if you just put a standby line of credit in there, there's hardly any interest that's ever going to accrue. But it's kind of going back to what you mentioned earlier. I think the traditional thinking that we've probably evolved, born and raised in, and realized that, hey, we got to pay that house off, leave it to the kids. I've ultimately said, as cost of living goes up, take care of yourself, give yourself a better chance of retirement. If you're worried about what you're leaving behind to your children, church, whomever you're leaving it behind to, I would say a warm hand's better than a cold hand. If you want to start giving that away now, start doing that. It's another way to do it. But I'll tell you, Tony, and I think this is just important. This not us promoting New American Funding. This is about the product in itself. Is, through all the 15 years of doing this between myself and my teammates, we've helped out tens of thousands of folks with this product. And not one time have we ever had anybody call in and say, gosh, we wish we hadn't done it. But there becomes the education part, right? Overcoming the objections. And we will tell people at times that maybe this is not the product fit for you, because ultimately, if it's going to be a product that you're only going to be in for a year or two, based on the cost to benefit, it may not make sense for you. So just hang on, don't do the reverse mortgage. So we will be upfront, just make sure that it's a product that fits the mold for them.
Yeah, I think most mortgages, if you're only going to have them for a couple of years, probably don't make a lot of sense. They're expensive to originate. This one comes with insurance, FHA insurance, just like other FHA loans do. So yeah, the cost benefit there. The other thing I would say is, if you've talked to your financial advisor about this, they're not all created equal. I mean, if you're working with someone who's a true fiduciary, who's really taking into consideration what you and your family need to make it through retirement, I'd be shocked if they would not be open to knowing or already know about reverse mortgages, and how for some families it can be a huge part of that strategy, as Mike said. Well, sir, I want to thank you for taking your time to come on and talk to us about this. To our audience, like I said, I'm going to do a few other episodes, I think, in the future about reverse mortgages. I want to bring some people on, that maybe have some different ideas and structures and hear more stories, because I think if we can get this out there and resonate with people, I'm hoping that we can be part of that movement that at least gets people to take a look at this product. And none of us want to see, like our aging population struggling unnecessarily when there's some products out there like this that for many of them could be a solution to their problems. So thank you guys for your time and attention today. Thank you, Mike, for coming on. And you guys, if you like this content, as I say every week, please share this with someone that you think would benefit from this information. If you have questions, comments, things you want to see us follow up on, put them in the comments down below. And I will see you guys next Friday on Market Shares. Take care.